For those serious about becoming successful, consistently profitable options traders, now is the time to build skills in technical analysis, market analysis, and applied volatility to get those results. We have multiple memberships, starting with our Go membership that teaches rules-based trading and our Pro membership that teaches more subjective trading. For more information, go to lockeinyoursuccess.com/memberships.
Can you go over any considerations that need to be made when trading stocks and ETFs with options versus an index? Okay, so I understand that the index options are settled in cash and stocks and ETFs are settled with shares. Should one care that you can get potentially assigned a stock, are there any hidden pitfalls or topics to consider when trading stocks, ETFs, such as early exercise? So you should be aware of the types of options that you are trading in on your asset. For the most part, right, our SPX options, our Russell options, and NDX are major. For the most part, our major indexes are cash settled options. Our cash settled options are not exercised early, right? Meaning that you don't have to worry about getting assigned before assignment, right? Because there is the assignment date when they are assigned, but you don't have to worry about getting assigned the option right up until the time that it expires. So there's really no issue with that. When they do settle, if you're in the money, they are assigned and they're settled in cash, right? So realistically, after the end of that, the cash comes out or into your account, and then it's a done deal. It's over, right? We also have two with the index options. One should be aware of is we have our weekly expirations and so forth, and then we have our standard monthly expirations. Weekly expirations are PM expired options. You should know the difference between a PM expired option and an AM expired option. They're both cash settled, but one of them expires a little after the end of the trading day. The other one is settled based on the price. One is settled based on the PMs are settled based on the price 15 minutes after market close. The AMs are settled based on a calculation of where the opening prints are in all the stocks related in the option on the day, on the following day, meaning that where the actual settlement price could be very far from where the market closed on the day before, and it could even be fairly far off of where the market opens on the next day. So to me, that's nothing really to be scared of, but you should be aware of it. Other options are actually settled by the asset. These we can be assigned at any time, right? So, if I'm short the option, I can be assigned at any time. So if I'm short an option, whether that be in a vertical or a butterfly or a calendar, if I'm short a SPY option on SPY, for example, ETF, then that's the way most stocks are going to be also. That means that they could assign me the stock, right? So now I'm either, if I'm put option, right, it's the other way around. But I could be assigned that at any time. Now, theoretically, we're in the same position risk-wise. So, like if I have a call option and I'm short a call option, and I end up being, I would be short 100 shares of the stock, then I have that call option offsetting that. So theoretically, I'm in the same risk position. Realistically, from a theoretical standpoint, I would like that because I sold the option and I got all this time premium, and now I'm short the stock. Okay, fine. I'm synthetically in the same position. I would just buy the stock back and then I would sell the option again. I'd be in the same position. I collect time premium twice. Woohoo, right? That's wonderful. The problem that, right, so from that perspective, I'm not really concerned about it. But the problem I may run into is that I don't have the cash in my account to be short 100 shares of SPY options, because I have this actual risk at the given time, and then I have the risk at which the broker is going to assign me. And if you're short 100 options of SPY, that's going to be a very big number. 100 shares of SPY, that's going to be a very big number. And you may not have the money to cover that in your account, in which case, what can happen is the risk managers can see that, and they can deal with that any way they want, right? So the bigger problem I have is it puts you out of control of what's going to do. And they can margin call you, they can lock your account, they can liquidate your assets. Very bad things can happen you don't want. Now, theoretically, they said, well, most of the time that doesn't happen. Like if you talk to the broker, most of the time that doesn't happen. Usually we give you a day to straighten it out and do whatever you have to do with the shares. But they can do that, and I don't personally like that risk. So for me, if I don't have the cash to be assigned the option in an ETF, or a stock to be in a vertical, then I just won't do it. Which is one of the reasons I like the indexes, because I just don't want to take that risk of having them take control of my account, because unless I have the cash for it, I don't want to take that risk of not knowing what they're going to do. But that is a real risk. So again, from the perspective of I have enough money in the account, it doesn't really matter. You're in the synthetically same position. You can either buy or sell the stock, buy back the stock that you got assigned short, or sell the stock you were assigned long. You can resell the option. You can carry on and go and move on. But if I don't have the cash to do that, which I might not, like if I do a 10 lot in the SPY and I get assigned, either long or short, 10 lots, 1,000 shares of SPY, that's a lot of money, right? I'm only taking a small risk. I'm probably doing verticals because I don't have the money to buy the stock. So, that's, again, that can be problematic. Also realize too that if you settle these, you can get assigned your long stock. You will be assigned your long stock if you're in the money. So like if I'm in a SPY, an SPX index call, and I'm at a 1,000. Say I have 1,000 strike call on, and the index settles out, or the option settles when the SPY is at 1,050, then I just get the cash, right? Wonderful. If I am in a SPY at $100 and it goes to 150, then I take the stock at 150, which means I need to have the money to buy that stock. And if I don't have the money to buy that stock, then now I'm dealing with a margin call. And again, things kind of get out of my control. So you have to watch that in that aspect. Those, to me, those are really the risk that's involved in that. Now, chances are you're not going to get assigned if you have a lot of time premium in your short. If I have a short strike and it's got a lot of extrinsic value, very rarely are those assigned, but they can be, right? Because these things are randomly assigned. I mean, if somebody turns around and says, "I want to assign a," I want. If somebody has the other side of your short option, if you have a short call and somebody has the other side, and there's a lot of time premium in it, and some other party wants to, for whatever reason, take that, which it happens, they could assign it to you, right? Which is random. They assign it to random people. They could assign that to you, and then you could get assigned the stock, even though it's got time premium in it. Again, if I have the money and my broker handles this properly, it's not an issue for me whatsoever. For me, I worry about the broker saying, "Oh, you don't have this money. We're margin calling you. We're locking the account." Well, then now that's a problem for me, right? Because I don't know what else I got going on, or whatever. And they could conceivably say, "Hey, we're going to liquidate this." Especially if you get a day that where you start to get really big price movement intraday, and they end up, you end up in this mess. So for that reason, I don't like it unless I have the cash to cover it. And I guess that's all I would say. The only other thing that I would say is we do have assets with dividends. So like IWM and SPY pay dividends, and when they pay dividends, that comes out of the price, the asset price. And when it comes out of the asset price, and since it affects the asset price, it also affects the calls, or the value of the or the intrinsic value in any of the options that you have. So I mean, that could be a good thing. It could be a bad thing, whether you're puts or calls, or whether you're both in the money. Like if they're both in the money, it doesn't really matter. If they're both out of the money, it doesn't really matter. But when one's in the money, one's out of the money, that makes a difference. I mean, it's a difference. I don't know if I'd be overly worried about it, but you should be aware that it's there. Other than that, caution on stocks is that stocks can lose and gain. They tend to be more volatile than an ETF, for example. So they can lose and gain more money faster than the indexes. So that's a consideration when you start looking at structural risk within your position. In other words, I don't like high structural risk, low reward trades in a stock. If I'm right, unless I wanted to own the stock, right? So still a naked put, I want to own it. Fine, right? Not a problem. But if I'm doing like verticals on a stock, for example, or a butterfly, or condors that have a very high structural risk, and I'm not going to get much of a reward, I have to think about that. Hey, this stock moves a lot, and I'm much more likely to take that structural risk loss on a stock, particularly if I get closer to expiration, than I am on an ETF. I could on either, but I'm more likely to take it on a stock. That being the case, I'm going to tend to stay in the lower structural risk things. I always want to ask myself, well, if this if I trade this 100 times and do it this way 100 times, and I hit this 1% of the time, right, once, is that going to kill my profitability? And if it is, then I'm generally not going to trade that way. Okay, so just that's what I have for considerations.